Good morning. My name is Frank Grinnell. I've been advising professional money managers and investing in the stock market for over 20 years. It serves as my day job, but most importantly, it is my absolute passion. On Street Views, I offer my daily viewpoint on the stock market in under 7 minutes. I will cover things like the global macroeconomic picture, the mood of the market, company-specific news, secular trends with some actionable sector and stock calls. I hope my insights are useful to you, whether you are a professional money manager or a passionate investor. At Grinnell Capital, we actively manage dynamic stock and ETF models for financial professionals and their clients, as well as individual investors. If you want to learn more about what we do, send me a note, frank@grinnellcapital.com. You can also find more of my insights on Twitter @GrinnellFrank. And now, today's Street Views. Hey, good morning. It is Thursday, post-Fed Day, September 22nd, 2022. It's a lot of red. Sorry for the late start here today. I am single parenting. My wife's traveling. She's in New York, so I am taking care of the kids and whatnot, so they're off to school. So obviously the Fed actually did manage to come across. I mean, they call up more hawkish than expectations, but at the end of the day, they reiterated their stance that they made clear at Jackson Hole. They're going to tame this thing no matter what it takes. Whatever they do is going to be enough. Yada, yada, yada. So the market taking that to heart, selling off again here today after a 1.7% drop yesterday, off about 1% on the S&P again here today. I will say that, number one, expect to retest those June lows. That's just happening and probably going lower. So just, I guess, wrap your head around that. But the other thing, near term, doesn't mean we're going to go there in a straight line. I do see us as I see buy indicators on the technical work that I do for the S&P, actually for the XLK technology as well. Doesn't feel like it at this moment, but I am seeing that. So what I've done, we actually took some off the table on volatility. We still are keeping our inverse ETFs. Again, we don't short stocks, but we can purchase inverse ETFs. So we own the SH and the PSQ, inverse S&P and triple Qs. We've kept those intact, but we did take down some volatility exposure. We could see, who knows, again, things don't go in a straight line, but then again, crashes do tend to come from oversold positions, so you never know. The unfortunate thing here, a lot of stocks that have had some pretty constructive charts, making higher lows and what have you, that seems to be ending. Casinos are breaking down again. Caesars, MGM, we've exited those positions where you had little starter positions in those. We are gone. Those look like they're just going to go lower. And that kind of rings true for a lot of areas, especially the next-gen technology, which was holding up, like, if you want to talk about GitLab or HashiCorp, HCP, those things are, just playing on new lows. Snowflake, these things, 3.5%. They're just going to go down. That's just it. That seems to be what's going to happen. We're going to. We got a good upgrade on Eli Lilly, so farm is still working. Med device acting really crappy, disappointingly. So that trade is now in jeopardy as far as I'm concerned. I think what's happening is some of the more expensive areas within med device, whether it be Intuitive Surgical, are kind of weighing down the space with outsized declines versus like a J&J or a Medtronic or a Stryker, which might be holding up relatively okay. So that's been a little disappointing. But other than that, defense I still think looks good on the pullback. I don't know why they're selling Raytheon here. Things like that look good. I think if you didn't listen to our webinar we did a couple days ago, go pull that up, check that out. We did talk about spaces and areas we do like. Ag, I think, can make sense, like a Mosaic, still holding up okay. ADM still holding up okay. Archer Daniels. Those things I think can work. That's all I got. Have a great day. We will talk to you in the morning.
disclosures. Grinnell Capital is a state-registered investment advisor. Services offered by Grinnell Capital can only be offered in certain states where Grinnell Capital is registered or meets required exemptions. Registration does not imply a certain level of skill or training. For additional information about Grinnell Capital, including its services and fees, please review the firm's disclosure statement as set forth on Form ADV and available at no charge at advisorinfo.sec.gov. This podcast is provided for informational purposes only. The information contained herein should not be construed at the provision of personalized advice and is subject to change without notice. This material should not be considered as a solicitation to buy or sell any asset or engage in a particular investment strategy. Investing in securities involves the risk of loss, including loss of principal invested, and may not be suitable for all investors. Past performance is no guarantee of future results. This podcast contains certain forward-looking statements which indicate future possibilities. Actual results may differ materially from the expectations portrayed in such forward-looking statements. As such, there is no guarantee that any views and opinions expressed will come to pass. All expressions of opinion reflect the judgment of Grinnell Capital as of the date of publication and are subject to change without prior notice. This podcast contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to the accuracy of any information prepared by any unaffiliated third party incorporated herein and take no responsibility therefore. This podcast is provided with the understanding that Grinnell Capital is not engaging in rendering legal, accounting, or tax services, and we recommend that you seek out the services of professionals in these aforementioned areas. The principal investment focus of the accelerator model, the strategy, is to achieve strong relative and risk-adjusted returns, primarily by investing and trading in securities issued by companies that focus on the global information, technology, consumer, healthcare, industrial, and infrastructure sectors. These sectors are characterized by robust secular growth, an abundance of both new and maturing product cycles, a high degree of competition that creates the potential for relative winners and losers within a subsector or theme, a high degree of revenues and earnings volatility, rapidly changing sentiment and public perception, significant yet unrealized potential for globalization, and superior relative liquidity. Investment in the strategy is speculative and involves a high degree of risk. The second investment model is called the ignition model. The ignition model is an all-exchange-traded fund, ETF, strategy with investment objectives similar to the accelerator model. This model seeks to capitalize on long-term growth trends experienced by the market leaders in various areas and sectors. The ignition model will also seek ETF investments based on cyclical forces experienced in the U.S. and the global economy. This model is also designed to have the ability to offer some downside protection in the event of significant market stress through investments in ETFs designed to take advantage of market volatility. The strategy's performance can be volatile. Grinnell Capital has total trading authority over the strategy. The use of a single manager applying similar trading programs can mean a lack of diversification and consequently higher risk. For more important disclaimers, please visit our website, grinnellcapital.com.